So today's video is Stay Alive till 25. So we're going to talk about why the Fed is between a rock and a hard place, and of course, the moves you must make in the next 6 months if you want to stay alive to 25. For this video, we're going to focus on 3 main areas: the Fed's next move, inflation, and employment. All have to do with the Fed's next move. As you look at this slide, you can see that the Fed has raised rates 10 times, and the inflation, when you pull out housing, has not been that great, as evidenced by the Fed's minutes from May, and they're very concerned about low unemployment, which is driving wage growth, which is also inflationary. So one of the things you need to pay attention to is the Fed's fund futures, which is by the Chicago Mercantile Exchange. And what this does is it ranks the probability that the Fed will raise rates for the next 2 meetings in June and July. Now, everyone is talking about the Fed's going to cut rates, but I can guarantee you they're not going to go from aggressively raising rates to rate cuts. If they do anything, they're not going to raise rates at all, or they're going to raise rates a quarter point. This is a very good watch tool if you own real estate or you're looking to invest in the future, because this is a pretty good predictor of what the Fed's going to do in the next 2 meetings. What you should not bank on is a Fed rate cut this summer. This next slide is in September of 2023, and you can see the probability is almost 67% that the Fed is going to continue to raise rates during that time. So why is this important? Because 3 rate increases are going to severely affect real estate prices. They're going to affect whether or not people can buy houses, and they're going to affect the rental market. All 3 things are going to be affected. The reason why the Fed wants to do this is because housing is a big part of the CPI, and they're trying to actually cool it down. For those of you who do not believe me, this is James Bullard, the Federal Reserve Bank president from St. Louis. I think we're going to have to grind higher with the policy rate in order to put enough downward pressure on inflation and to return inflation to a target in a timely manner. And we all know that the Fed's target is 2%. I'm thinking 2 more moves this year. Exactly where those would be this year, I don't know, but I've often advocated sooner rather than later. Inflation is expected to continue to be a problem for the Fed, as you can see from this new survey by the National Association of Business Economics. But what I really want you to pay attention to is the very last sentence here, because this is what I'm seeing across the board by most of America's top economists. Just 2% of NABE forecasters surveyed said they believe inflation will have slowed to 2% by the second half of 2023, while a 59% majority do not believe that inflation will decline to the Fed's target level until 2025 or later. What this is saying here, folks, is that inflation continues to be sticky. Even when you take out housing, it still is very high, much higher than the Fed wants. And therefore, it's going to be higher longer, and that's why we say stay alive to 25. So this next chart is a very interesting one, and it measures inflation and wage growth. What I want you to pay attention to is the blue line, and as you can see, there's been some pretty aggressive wage growth from just a year ago. This is definitely on the Fed's radar because as unemployment is really low, wages continue to rise, which are inflationary, which contributes to the CPI. Unfortunately, the downside of this is higher unemployment, which is not necessarily good for the economy either. So as you can see, as of March, which is the latest data, there were 1.6 job openings for every unemployed person, well above the 1 to 1.2% range that is consistent with the jobs market that is not generating too much inflation. So you can see we're well above the markers that the Fed wants right now when it comes to employment. So let's forget about housing for a moment and just focus on this. This is an inflationary problem, which is one more reason why the Fed is going to continue to raise rates for 2023. So what can we expect in staying alive to 25, and what can we do about it? The first 3 things are you can expect that more interest rate increases and no cuts in 2023 are going to happen. Second, inflation remains higher than the Fed target through 2024. After 10 rate increases, it's only gone down about 5%, and the Fed still has another 3% to go. Third, unemployment will increase to curb inflationary wage growth, but the result of that will be more people unemployed, which is not necessarily good, which is going to lead us into a recession on the second half of 2023. What are the things that I'm doing here at MC Companies right now? The first thing is cash is king. The second thing is to refinance to a fixed rate debt to hedge any potential future increases in the future, but also now you're hedged to a position if rates go down in the future, you can also refinance to a lower rate at that time. The third thing is to focus on improving operations. We're seeing all kinds of things go up. Labor's gone up. Insurance has gone up, property taxes have gone up, utilities have gone up, marketing costs, and supply chain issues have all driven expenses much higher on some properties that we've owned for some period of time. Focusing on improved operations and hunkering down and really dealing with each project on a line item by line item basis is going to get you in a much better position for when you are in an actual refinance or potential sale opportunity. So these are the three moves you're going to need to make to hedge the rest of 2023 and through 2024 if you're going to stay alive to 25.